Hello, CA Inter Warriors. Today we are tackling a chapter that looks so simple on the surface but is absolutely loaded with traps set by the ICAI. And I'm talking about the value of supply. If you get this right, you're looking at some solid, easy marks. But if you get it wrong, the whole question goes down the drain. So let's make sure that doesn't happen. All right, let's dive in.
So, let's kick things off with a classic exam-style puzzle. Imagine you provide a service. Your customer pays you 90,000 rupees, but to help them out, their friend transfers the remaining 10,000 rupees directly to your bank account for that same service. Now here's the big question for GST. Is your taxable value 90,000 or is it the full 1 lakh? Think about it for a second. This is exactly the kind of question where students get tripped up because the answer is buried in the details of the definitions. We'll circle back to this and you'll know the answer for sure by the end of this.
And here is the main problem we're going to solve together today. Black and White Company sells a machine to Pearl Company for 5 lakh rupees. Now the contract says Black and White is responsible for delivery. But the buyer, Pearl Co., goes ahead and pays the 20,000 rupee freight charge directly to the transporter on behalf of Black and White. So what is the correct value of supply for GST? Is it 5 lakhs or is it 5,20,000? Let's figure it out.
So first up, why all the fuss about this one single calculation? Well, honestly, it's because it's the very foundation of how GST works. See, GST is what's called an ad valorem tax. I know, it's a fancy Latin term, but it just means according to value. It's not a flat fee, it's a percentage, 5%, 12%, 18%. And that percentage is applied to a value. So if your base value is wrong, everything that follows is wrong. And this is the part that should get your attention. If you mess up the value of supply, your entire GST calculation is wrong. Your final answer is wrong. And you know what that means in an exam? 0 marks for the question. It doesn't matter if you got the tax rate right. This is step 1 and you have to nail it. Okay, now that you know how high the stakes are, let's make sure we have our tools ready. To really understand Section 15, we first have to get comfortable with the words the law uses. This part is absolutely non-negotiable. All right, let's start with the big one, consideration. Section 231 says it's any payment, whether it's in money or something else, for a supply. But here's the part I want you to underline, highlight, and star in your notes: by the recipient or any other person. This little phrase is a goldmine for ICAI questions. It doesn't matter who pays. If the payment is for the supply, it counts. So let's break that down. Consideration can be cold, hard cash, or it can be in kind, like a barter deal. It can be an act, like performing a service, or forbearance, which is just a fancy word for agreeing not to do something. And as we just saw, the payment can come from the person buying or a totally random third party. The only thing that's specifically kicked out are subsidies from the central or state government. And here is a massive, massive exam tip for you. A security deposit is not consideration when you first receive it. It's just security. It only becomes consideration at the very moment the supplier says, okay, I'm using this deposit to pay off your bill. This distinction is a classic MCQ trap. They love testing this, so don't fall for it. Next up, supplier. This one's pretty straightforward, thankfully. Under Section 296, it's simply the person who is supplying the goods or services. Oh, and it's important to remember, this also includes an agent who's making the supply on behalf of someone else. Okay, so what about the recipient? Who is that? Section 293 gives us a really clear 3-step logic. Step 1. If money is changing hands, the recipient is the person who's liable to pay that money. Simple. Step 2. If you're giving away goods for free, the recipient is whoever you deliver the goods to. And step 3. If you're providing a service for free, the recipient is the person who actually gets that service. And finally, you'll see the word person used everywhere in the law. So what exactly is a person? Well, under Section 284, it's basically everything. It's not just an individual like you and me. It's a Hindu undivided family, a company, a firm, an LLP, the government, a trust, the list goes on. The main takeaway here is that the definition is super, super broad. All right, with all those definitions under our belts, we are ready. It's time to tackle the master section, the absolute core of this entire chapter, Section 15. This is the golden rule. So Section 15, subsection 1, starts off simple. It says the value of any supply is going to be the transaction value. Now, transaction value is just the price that was actually paid or is payable for that supply. Basically, it's the invoice price. But, and this is a really, really big but, you can only use that invoice price if 2 very important conditions are met. You have to check these 2 things in every single question. First, the supplier and the recipient are not related persons. Like family members or a holding company and its subsidiary. If they're related, the price could be manipulated so the law doesn't trust it. And second, the price has to be the sole consideration. That means there's no secret barter deal on the side, no other payments happening. The price on the invoice is the one and only thing being exchanged.
So what happens if one of those conditions fails? What if the parties are related, or what if there's some other form of payment involved? Well, in that case, you just can't use Section 15.1. You have to switch over to a special set of valuation rules. Now, don't worry, those rules are a whole topic for your CA final. But for Inter, you absolutely have to know these two conditions and mention them in your answers. Okay, so let's say we're clear. The parties aren't related, and the price is the only consideration. Is the invoice price our final answer? Not so fast. Section 15, subsection 2, gives us a list of things that you must add back to the price to get the true value. And here it is, the real key to solving our problem, Section 15, 2b. This says you have to include any amount that the supplier was supposed to pay, but which the recipient ended up paying on their behalf. And the crucial last bit is, as long as it wasn't already included in the invoice price. Think of it as the supplier's headache, but the recipient paid for the aspirin. So let's connect the dots back to our problem. Black and White Co. was liable to pay that 20,000 rupee freight charge, but who actually paid it? The recipient, Pearl Co. This situation fits Section 15.2b like a glove. It was the supplier's liability paid by the recipient, so it absolutely must be added back to the price. This is the exact kind of twist ICAI uses to separate the students who really know the law. And there you have it. The correct value of supply is not 5 lakh rupees. It's the 5 lakh rupee price plus the 20,000 in freight that the recipient paid. The correct taxable value is 5,20,000 rupees. Your entire GST calculation will be based on this number. And what about that very first question, the 90,000 from the customer and the 10,000 from their friend? Well, remember our definition of consideration? It can be paid by the recipient or, say it with me, any other person. That friend is the any other person. So yes, that 10,000 is absolutely part of the consideration, and the total value of supply is the full 1 lakh rupees.
We are jumping straight into a super critical, exam favorite topic today, how we handle discounts under GST. This is one of those areas where ICAI just loves to set traps. So let's make sure you're the one who doesn't fall for them. Let's get right into it.
So let's kick things off with a question that trips up so many students in the exam hall. Imagine this. A supplier gives a discount, but they do it after the goods have already been delivered and the invoice is out. So, can they go back and reduce their GST liability? Now, the answer here isn't a simple yes or no. And believe me, getting this wrong is where marks are lost. But by the end of this session, you're going to be able to answer this one with 100% confidence.
All right, before we dive into the really tricky stuff, let's build ourselves a solid foundation. We're going to start with the simplest scenario for discounts, the one that's super straightforward and an easy way to score marks. Okay, so first up, let's look at the foundational rule in Section 15.3.8. It gives us a really clear two-part test. A discount is deductible from the value if, 1, it's given either before the supply or right at the time of supply, and 2, it's clearly shown on the invoice itself. That's it. It's that direct. No confusion, no complex math. Let's make this real with an example. Take Royal Biscuit Co. The list price for their biscuits is 200 rupees, but they give a 30% discount right there on the invoice. So what's the taxable value? It's the net amount, 140 rupees. Simple, right? GST gets charged on that final 140. This is Section 15.3a in action. It's perfect. And this simple rule isn't just for your standard trade discount. It also covers things like cash discounts for paying right away, or quantity discounts for buying in bulk, or even those buy more, save more kind of offers. The one key thing to remember is this: as long as it's shown on that invoice, you're good to go. Okay, so we've got the straightforward case down. Now, let's get into the area where ICAI really lays its traps. Let's talk about the post-supply discount. I mean, just think about it from a business perspective. It's not always possible to know the final discount amount when you're raising an invoice, right? Maybe there's a volume bonus that depends on how much a customer buys over a whole quarter, or maybe there's an early payment discount that you don't know if they'll even take. So, how do we handle these discounts that are given after the supply is already done?
Okay, everyone, pay close attention, because this slide is probably the most important one for your exam. To deduct a post-supply discount, you have to satisfy both conditions of Section 15.3b. There's no picking and choosing here. First, there must have been a prior agreement. The terms of the discount had to be known before the supply happened, and you need to be able to link that discount back to the specific invoices. Second, and just as important, the customer who got the discount must reverse their proportionate input tax credit. Both have to happen.
And here's exactly where people lose marks. If you fail to meet even one of these two conditions, you absolutely cannot reduce your GST liability. The supplier can still give the discount, sure, but they have to issue what's called a commercial credit note, which is just for the value, no GST adjustment. And in that case, the buyer doesn't have to reverse any ITC.
Now, this slide perfectly illustrates that classic ICI twist. Look on the left. Pink and Blue Ltd had an early payment discount written right into the original terms. The customer pays early, gets the discount, and reverses the ITC. Both conditions of our checklist are met, so the discount is deductible. But now look at the right. It's the same situation, but this time the discount was offered later during a negotiation. See the difference? Because that first condition, a prior agreement, is missing, the discount is not deductible for GST purposes.
So let's quickly classify these. You've got your periodic or volume discounts, right? These can be deducted, but only if they satisfy our two-point checklist. Then you have what are called secondary discounts, like a special incentive to clear old stock that you offer later. These are almost always not deductible because there was no prior agreement. Same goes for annual turnover discounts. They generally aren't deductible because they're finalized way after the original supply.
All right, now for a special case that's been clarified and is a great potential exam question, the no claim bonus, or NCB, you get on your insurance renewal. How does this fit into our rules?
So, is NCB deductible? The good news is, yes, it is. And you know why? Because it actually falls back into our easy case. Think about it. The terms of the NCB are part of your original policy, so you know about it beforehand. And when you renew your policy, the discount is shown right there on the new invoice. It perfectly meets the conditions of Section 15(3)(a). So GST is paid on the net premium after deducting that NCB. Easy peasy.
All right, we have totally locked in the rules for discounts. So to finish up, let's test your knowledge with a quick rapid-fire round. We'll cover a few other common valuation adjustments you're going to see in your exams. You ready?
First up, subsidies. Let's say a product's price is reduced because of a subsidy from an NGO. Do you have to add that subsidy back to find the value for GST? What if that subsidy came from the state government instead? What do?
Okay, the answer is yes, you have to add back the NGO subsidy. But if the subsidy came from the central or state government, you do not add it back. The rule is simple and it's absolute. Any non-government subsidy that's linked to the price gets included in the value of supply. Government subsidies do not. Got it?
Next question. Picture this. You, the supplier, were supposed to pay a vendor for something, but instead, your customer pays that vendor directly on your behalf. Do you need to add this amount to the value of your supply to that customer?
Yes, 100%. This is a classic inclusion you cannot forget. If the supplier is liable for a payment, but the recipient makes that payment instead, that amount is treated as part of the price. You have to add it to the value of supply. Don't miss this adjustment in a problem. It's an easy mark. Okay, let's bring it all the way back to discounts for our last question. To boost your sales, you give an extra, totally unplanned discount to a dealer to help them clear out old stock. Can you deduct this from the value for GST? And the answer is a very clear no. This fails our post-supply discount checklist right at the very first step. There was no prior agreement, right? This is a classic secondary discount, and you cannot use it to reduce your GST liability. All you can do is issue a commercial credit note.
Okay, we focused a lot on calculating the transaction value based on what's on the invoice. But I want to leave you with a final critical thought. What if the buyer and seller are related parties? Or what if the price isn't the only thing being exchanged? Can we still just rely on the invoice price?
And the answer to that is no. This is the trigger point where Section 15(1) just stops applying. If the parties are related, or if the price isn't the sole consideration, that transaction value is considered unreliable. We have to reject it and use the specific GST valuation rules instead. Knowing when to use transaction value and when to switch to the valuation rules is an absolutely key skill for your exams.